So thanks, Chilmar, for the introduction. Also, a warm welcome from my side, and welcome to our Zug offices for people that have never been here. I'm very glad to have this event tonight and present or explain a bit more into detail how proof of stake works and how this could be a big thing in the future. So as a first thing, I would like to, no, that's the wrong button. I'd like to take a step back to the origins of Bitcoin, of cryptocurrencies in general, since it was the first one, and see why it was actually invented. So, as we all know, it came as a consequence of the financial crisis 2009 or 8 until 9, and where people were just kind of getting sick of banks collapsing, intermediaries taking horrendous fees, and defrauding people, and just in general being a central point of failure. So people behind Bitcoin were not sure who they are. Still to this point, tried to create a trustless peer-to-peer payment method that allows people to pay between each other without a financial intermediary, without giving up the security and the uncorruptedness of knowing that your transaction actually arrives at the other end. This is why I chose this quote from Andreas Antonopoulos, who is a big Bitcoin advocate and a very known man in the space. When he said, it's regulated by an algorithm, so it's not unregulated, but it's uncorrupted, since you don't have the intermediaries like governments and bureaucracies that can interfere and basically do whatever they want as a central authority. Having said that, let's move on. Let's move on.
Still on mute? Ist er noch auf mute?
Ich bin auf mute. Nee, oder? No, okay. So let's take a look at what proof of stake is trying to solve by taking a look at what might be some issues with proof of work, and especially Bitcoin as the biggest currency in the space. So just in general, resource consumption for mining blocks in Bitcoin and generally proof of work is really expensive. As we can see here, 1 year of the Bitcoin protocol currently causes 31 million tons of CO2. Roughly the energy consumption of the Czech Republic and electronic waste in the magnitude of the country of Luxembourg, which is obviously not optimal, right? Since it's only one currency, and we're still in the adoption phase of crypto in general. So we can only imagine how this would look in 20 years when adoption is way further. We have hundreds of currencies that have established themselves and billions of potential users that use it. This will only get worse and probably exponentially as well. So there's real incentive to build something that scales well in the future. Second, or actually more into depth, what we're trying to solve here, looking at block time, which translates basically to transaction speed in the end. We have for Bitcoin, for example, as the biggest one, an average block time of 10 minutes. And for comparison, just as an info, I will be referring to Tezos most of the time, since it's one of the biggest proof of stake coins, aside of Cosmos, Tron, Cardano, and others, but it's one of the biggest ones and most established ones in the space. So I'll be using that as an example. So for Bitcoin, as I said, we have about 10 minutes as a block time, and just as a little teaser, the longest block after the Genesis block, so the first one, which took about 5 days to get mined, took 1 day, 1 hour, and 9 minutes. Which, if you imagine that being in a situation where you want to buy a coffee is pretty much unacceptable, right? Because you can't wait more than a day for your payment to go through, for the shop owner to say, okay, coffee is yours, you can leave now. So that's a big problem, and there's not really a solution to predict how long the next block will take, since it's a random mathematical problem that has to be solved with proof of work. So this can take, it can take forever, but technically, but the probability of it being forever is very low. But so you never know. Basically, that's the issue. And Tezos as a counterparty has a block time of 1 minute, and it can consistently hit very close to those 1 minutes because it has a protocol that is differently built from the ground up, so it doesn't have this problem of scaling. There are obviously solutions like the Lightning Network for Bitcoin that try to solve this in proof of work. It basically works that in a way that you open a payment tunnel between two peers, and only the first and the last transaction of those two peers are then written to the blockchain, which makes it a lot lighter. However, every time you have a new counterparty that you want to interact with, you will have to open this tunnel and you'll have the same problem again. So it's kind of just bending the proof of work protocol to do what you want instead of actually solving the problem. Next up, transaction costs is also a big issue at the moment, not only for Bitcoin but also Ethereum. So recently, mining fees for Bitcoin, if you want your transaction to go through within the next 2 blocks, I'd say, are around $7.50, which is quite a lot. If you, for example, the coffee example again, if you want to buy one and pay $7.50 as well, just for the mining fees, that's quite unfortunate. Contrast to that again, and not only Tezos but all proof of stake coins actually are very low in transaction fees, at around 1 cent per transaction. People are willing to pay for the instant transactions, but definitely not $7.50 on a retail basis. Right, then let's move on to the scalability in general. So the way proof of work. Oh, I didn't mute everybody, I guess.
Hoffe es nicht, aber es wird ändern. Weißt du, dass es ändern wird? Aber ich hoffe noch nicht, dass es kommt.
How do I mute everybody? Does that somebody know?
Menu before.
Huh?
Yeah.
The menu before.
Ja,
Right?
das ist wie mit
Christian Girl.
Okay. There's also the new ones you have to.
Okay. All right, let's try. Right, so yeah, back to scalability. In proof of work, the difficulty is steadily increasing with the more participants in the network. So going down the line, we will need newer and faster hardware almost every second in order to keep the block time at 10 minutes roughly. So this is once again a problem if you want to envision Bitcoin still working in 25-30 years with 8 billion people, probably at that point around 10. So that's one thing we have to keep in mind. And proof of stake, in contrast to that, has no difficulty, so to speak, because the selection mechanism of the people of the next node that actually mines a block is completely different to proof of work. The only limiting factor we have in proof of stake is the block size. So even if you have instant selection of the next miner, you still have the block size which cannot exceed a certain amount, which is different per protocol, but it's a limiting factor which can be changed by the protocol, but it will just make the whole blockchain a lot heavier and difficult for people to catch up if they join after 10 years, for example. So quickly touched upon, so let's move on now to how proof of stake actually works and tries to solve these problems. As I said, instead of investing your hash power, so your machine power and your time into proving that you're not a fraudulent participant, you're locking some of your stake or some of your coins that you have in this protocol in the network as a collateral. This is just to make sure that people don't abuse the protocol, don't defraud other participants, and this is how it actually works. The signing itself is actually pretty similar or identical to proof of work, where you have your private key and your public key to sign and to prove that you're actually eligible to send funds out of a certain address. We have this pseudo-random selection mechanism that selects the next miner, and the way it selects the next miner is that you have this metric called coin age, which, as you can see here, is calculated using the time that you've held a coin, multiplied with the amount of coins that you have, and in the end, the participant with the highest number of coin age is the most probable to be able to mine the next block. Still doesn't say that it's exactly going to be him, but he has just the highest probability. And as soon as you've mined a block, your coin age is consumed, and you guys basically get pushed back into the line, and you'll wait until your probability is high enough again to mine the next block. And if a participant tries to be fraudulent and manipulate some blocks to his benefit, the network will notice that and slash his stakes, so he will be stakes will be deducted from his collateral, so that it is even less profitable for him to try to do something, because first he needs to gather a certain amount of coin age, so he needs to buy the coins, stake them, and wait for a certain time, and then also get slashed in the end, so it's really not profitable to try to fraud the system. Let's move on to the characteristics or the monetary policy of proof of stake coins. So generally speaking, for proof of stake protocols, there's no maximum supply compared to Bitcoin, so there's always a slight inflation, which is in a traditional world quite healthy for the price stability of a coin, since you can consistently get a slight yield out of it without the price of the underlying needing to go skyrocketing like in Bitcoin. And the way it works, that if there's a low participation in the network, so few people staking, the higher the annual reward will be a lot higher. And in the other way, if there's a high participation in the network, the reward will be lower per capita. And it's not that the protocol actually does that actively, it's just that if there's more participants in the network, you are less likely to mine a block, so you're also less likely to get rewards, which at the end of the year just translates into less yield, right? Every protocol has a sweet spot for the stake percentage, and this varies due to different reasons. So if you have a use case where you want a really high liquidity, because the coin is used for smart contracts or for other types of high speed transactions, then you might want to have a lower stake percentage because you need the liquidity. Other protocols that are more into peer-to-peer payments maybe, or just general security type of approach, they might aim for a higher percentage in stake. And for what we can see at the moment in the market, we have yields between 4 and 20% per annum, which is very lucrative comparing to the traditional market at the moment. 4 being the projected reward of Ethereum once that switches to proof of stake. We don't know when that is, but might happen soon actually. And 20% for the moment being Algorand, which is after the coins that I mentioned before, the next in line in terms of market capitalization. Good. Now let's move on to the different variations of proof of stake that we have. We have, so to speak, 3 different types of proof of stake. We have delegated proof of stake, first off. That is a protocol where you, as a smaller token holder that doesn't have the technical knowledge or doesn't have the minimum amount of funds that you need to run your own node, you can vote for the next miner, and if that miner then mines or mints the next block, as you say in proof of stake terms, then you get a reward. So in that protocol you get rewards for voting and creating a block. Leased proof of stake is what Tezos is using. You as a small token holder can, if you can't afford running a bigger node, you can just delegate. The terms are a bit synonymous, but you can delegate your stakes to another node, and then per percentage, your percentage contribution to that node is what your return will be when this node then mines a block. Additional roles exist in certain protocols. For example, in Tezos, you have the role of an endorser as well, which is a participant that just validates an already mined block and says, basically gives his signature next to it and says, yes, this block is valid, everything looks fine, and you also get a smaller, obviously smaller reward for that, but you still have another option to participate. And last but not least, we have the proof of work, proof of stake hybrid, which is not a new thing, so to speak. So you can have the hybrid with both variations of the proof of stake. It's just that you usually start off as a proof of work protocol, and then down the line you want to switch to proof of stake because it scales a lot better. The first currency to do this was Peercoin back in 2013, I think, or 12. And Ethereum 2.0 will be exactly the same as soon as it switches, because now, at this moment, it's a proof of work protocol. So let's move on to the concerns or the critics of proof of stake. As we quickly just touched upon, the hybrid doesn't come out of nowhere. So this is because the initial distribution of proof of stake protocols is very difficult, because as we've seen, you need an initial investment to run a node, and those can be pretty high. So either it's going to be the foundation that runs multiple nodes, it's going to be people that participated in the ICO or in a private sale at an early stage. So it's a really small circle of people compared to what you want to achieve from a decentralization perspective. That's why you're trying to create it as a proof of work at first that mines the coins from zero, and only people that actually participate actively get the coins, and then as soon as you have a sufficient decentralization level, then you want to switch to a proof of stake when you're sure that you don't have fraudulent nodes that try to manipulate the market or unilaterally change the protocol for their benefits and other fraudulent behavior. So that's basically what you're trying to achieve with the hybrid. So quickly to touch upon how you, as a private user, could participate in staking. It's actually really easy. Most crypto exchanges actually already offer staking out of the box. With a few clicks on your balance there, you can stake it. Most mobile wallets that you have on your phone also support this functionality, even with different selection of different staking pools that have slightly different fees or slightly different allocations of coins that you can choose from. Some custodians already start offering this service as well. And so generally it's really easy to participate, and that's why it offers a lot of opportunities compared to the traditional market, because it's really hard to get a yield out of the traditional market at the moment. And everybody has a smartphone nowadays. Everybody that is slightly interested in the market can open a crypto exchange account in a few minutes. So staking is really a really nice way to participate, one, in the decentralization, into the protocols, and also to earn a significant amount of yield. And staying in this field quickly, if we compare to the traditional market, where usually above 100,000 in your home currency you pay negative interest, at least in Switzerland and Europe. Bond yields are very low. So even if you have, for example, a 10-year US Treasury bond, you're looking at a return of about 0.9%, which is actually negligible over 10 years. The stock markets are rumored to be pretty overvalued at the moment, and gold is at an all-time high, so investors are looking for new opportunities to earn passive income and also move into a higher yielded section. And now let's move to how this would look from an operational perspective. So if a bank like SEBA would like to offer this to a client, what benefits are there for both sides, and what are the challenges that both sides might face in that perspective? So the first point we already discussed, but just to make this point very clear, if you stake, you're simultaneously having a long position in that coin. So one, you're long on this coin. Two, you accrue currency, so you get yield and you accrue. So you actually have a triple benefit if you're staking in a protocol. There are lockup periods. So if you're starting in a protocol, you have usually about 3 to 4 weeks where you don't earn any rewards. Varies from protocol to protocol, but it's still a lot lower than government bonds, for example. And last but not least, you contribute to the price stability if you stake, because if you have a lockup period when unstaking as well, then it's harder to panic sell. So if the very volatile coins move south, then a lot of people panic and sell. But if you lose the lock up and the lock out period twice, then you might consider again if you want to panic sell. So this is one way of limiting a little bit the volatility of those volatile coins, yes. And there's also the cross-selling aspect. So at the moment, if a client just deposits Bitcoin, he would usually pay a small custody fee. If you do this with a staking coin, he'll actually earn more yield on the stake than what he pays in custody, and he can use the stake coins for other products that a bank might offer, such as loans or margin trading or any other products where you need a collateral. So you can use it as a collateral and earn passive income on it at the same time. So that's very interesting for the client and also very interesting for the bank, because it increases the liquidity and actually makes the wheel turn. Let's move to things to consider. So from a theoretical perspective, does staking, delegating, voting, and everything that has to do with the protocol actually contribute to the decentralization of the protocol? I'd say yes, but you still have to consider that if you delegate or if you lease your coins to another node, you're at the same time decreasing the decentralization again, because you're attributing your voting power, your individuality to another node. So at first, by participating, you increase the decentralization, and then you put it right back down when you attribute it to somebody else. As I've said before, quickly, running a node on your own is still quite technical, so it's not for everybody still. So that's why, if you want to participate, it's the usual thing to do to delegate. So that's why you can't really say at the moment if for sure that it's contributing to decentralization. Is it too good to be true? It sounds like it, right? Because you get 20% on a certain coin without doing anything. You just have to delegate and then you wait. However, we cannot forget that those coins are still very, very volatile. It's not unusual to see 50% spikes in one day, up or down. So it doesn't help if you have 20% annual return if you then lose 200% in value, right? So don't forget that, even if it sounds very, very attractive. And last but not least, regulatory aspects at the moment still make the broader adoption very complicated, since there are multiple topics that are not yet clear, especially in crypto generally, but especially in the staking field, which I'll touch upon right in the next slide. And also a point that I want to mention, especially for exchanges. So exchanges don't give you the option to actually vote for yourself, even if you stake with them. So if you give your coins to the exchange to stake, you're making them a very big player, and then exchanges are usually by far the biggest players, and then have a very big power in this specific protocol, which can lead to problems, as we've seen in the past with Tron, for example, where the owners, or where the biggest nodes actually try to gain something from it unfairly. So, as a regulated bank, this is what we would have to do to offer this service to a client. Each coin that we would offer for staking to our clients, we would have to integrate it fully into our environment to securely hold it, stake it, and then also allow our clients to trade it in the end. So this is one barrier that we would need to overcome. The categorization of the asset itself is pretty tricky, since that it's still not clear even for Bitcoin in this space. So is it a currency? Is it a security? Is it something new? Still not definitely stated by the regulators. Same thing goes for the payout, especially in staking, because it's a completely new type of investment. So how will you categorize the interest that you get out of it? Is it a typical interest like in a currency? Is it a coupon? Is it a dividend that you reinvest, or is it something completely new as well? So regulators need to tell us, or tell any player in the field, how you would treat such an asset for the client in terms of withholding tax, maybe capital gain tax, any other restrictions that you might have. So there's still a long way to go in that space as well. And yeah, as quickly mentioned before, the voting, how that might be regulated. So if there's a protocol that offers participants to vote, how does a bank need to treat that? So will the bank be able to vote as a bank with their own will, or do they have to vote for each participant independently, or are they not allowed to vote at all? So those are the three options that you would have in such a situation, and this is all still not clear. That's why, yeah, it's still a bit difficult to start straight away with those services. Right. So this is actually it from my side. I hope you could take something home with you, and I would then offer myself for questions if there's any. Also from home, if anybody has a question,